They tell you it is the golden ticket. They tell you that getting into that glass-walled room on Sand Hill Road and signing the term sheet is the moment your life changes forever. And they are right. It does change your life, but not in the way you think. You are about to sign away your freedom, your vision, and quite possibly your entire financial future, all while they smile and shake your hand. This is the story they do want you to hear. This is the mechanics of the machine that grinds up founders and spits out billions for the select few. Welcome to Silicon Valley's darkest secret, the venture capital trap. Most people think the game is rigged against you if you fail. That makes sense. If the business goes under, everyone loses. But here is the secret that nobody whispers until it is too late. The game is rigged against you even if you succeed. Build a company, grow it to $50 million in revenue, sell it for $200 million, and walk away with absolutely nothing. Zero. While the investors buy their third yacht. How is that mathematically possible? It starts with two words that are buried deep in the legal paperwork you are too excited to read carefully. Liquidation preferences. Imagine you bake a pie. You own the whole pie. An investor comes in and says, "I will give you money to make the pie bigger. But if we ever sell this pie, I get my money back before you get a single crumb." That sounds fair, right? But then they add a twist. They say, "I want a 2x participating liquidation preference." Now, that jargon is designed to bore you, but here is what it actually means. It means if they put in $10 million and you sell the company, they take the first $20 million off the top. No questions asked. That is the knife in the back. It means after they take their $20 million, they also get to dip back in and take their percentage share of whatever is left. They get to double dip. In a scenario where you sell for a modest success, the math works out so that the investors take everything, and the common stock that is you and your employees gets wiped out. But the trap isn't just financial, it is psychological. It is called the growth at all costs addiction. When you bootstrap a business, you focus on profit, you focus on survival. When you take VC money, the goalposts move. Suddenly, profit doesn't matter. In fact, profit is often discouraged. They want you to burn cash. They want you to hire 300 people you don't need. They want you to spend millions on marketing to acquire customers who aren't actually profitable. Why? Because they need you to hit it for the next round of funding. It is a Ponzi scheme of expectations. You are no longer building a business. You are building a pitch deck for the Series B investors. And the moment that growth slows, the moment you miss a quarter, the trap snaps shut. This leads us to the boardroom coup. In the beginning, they tell you they are founder-friendly. They say they are there to support your vision. But look at the board seat composition. In the Series A, you might still control the board. By Series B, you bring in an independent board member. Usually, this is someone the VCs know, someone they play golf with, someone who relies on them for deal flow. Suddenly, you, the founder, are outnumbered in your own company. You are the CEO only as long as you are useful. The minute you try to pivot to a sustainable model instead of a high-risk moonshot, they can fire you. They can strip you of your title and replace you with a professional CEO who do exactly what they say. We saw this with Travis Kalanick at Uber. We saw it with Adam Neumann at WeWork. But those are the billionaires. It happens every single day to anonymous founders who are quietly escorted out of the buildings they built, leaving with nothing but a non-disclosure agreement. Let's talk about the dilution death spiral. Every time you raise money, you print more shares. Your slice of the pie gets smaller. That is fine if the pie gets massive. But what happens during a down round? Let's say the economy turns, like it did recently. You need cash to survive, but investors say your company is worth less than it was last year. They will give you money, but the terms are predatory. They might demand full Ratchet anti-dilution. This is a nuclear weapon in term sheets. It effectively rewrites history. It retroactively gives the investors more shares for their original money, crushing your ownership percentage down to single digits. You could end up owning 2% of the company you started. At that point, you are just an underpaid employee with a fancy title. And we have to talk about the exit. The unicorn dream. Everyone wants to be a unicorn, a billion-dollar valuation. But valuation is a vanity metric. It is not real money. It is a number on a spreadsheet based on the last check someone wrote. The pressure to reach that unicorn status forces companies to fake it. They inflate numbers, they ignore toxic cultures, they hide technical debt. Why? Because the VCs need a fund returner. Venture capital is a hits business. They expect 9 out of 10 companies to fail. They don't care if you build a nice, healthy, $20 million business that employs 50 people and makes you rich. To them, that is a failure. It doesn't move the needle for their billion-dollar fund. They would rather push you to take a 1% chance at becoming Google, even if it means a 99% chance of bankruptcy. They are gambling with your life's work. If the gamble fails, they write it off as a tax loss and move on to the next startup. You are left with the burnout, the debt, and the ruined relationships. There is also a darker layer to this: the signaling risk. Silicon Valley is a small town. If a top-tier VC firm invests in your seed round but decides not to invest in your Series A, you are effectively dead in the water. It sends a signal to every other investor that something is wrong with you. They call it signaling risk. Even if your business is fine, if your lead investor ghosts you, no one else will touch you. You become toxic assets. The very people who claimed they were your partners can destroy your company simply by doing nothing. So, why do we keep doing it? Why do founders keep lining up for this abuse? Because the media celebrates the winners. We see the IPOs. We see the ringing of the bell. We don't see the thousands of corpses of companies that were pushed too hard, too fast, and exploded. We don't see the founders suffering from depression because they lost control of their own destiny. The media feeds us the survivor bias. They show us the lottery winners, not the millions who bought tickets and lost their rent money. The reality is that for 99% of businesses, venture capital is the wrong tool. It is jet fuel. If you put jet fuel in a race car, it might go faster, or the engine might melt. If you put jet fuel in a family sedan, it just explodes. Most businesses are family sedans. They are meant to be profitable, sustainable, and owned by the people who run them. But the VC machine needs you to believe that you need them. They need you to believe that without their millions, you are irrelevant. That is the trap. The belief that validation comes from a checkbook. If you are a founder, or aspiring to be one, you have to read the fine print. You have to understand that a term sheet is not a partnership agreement. It is a divorce settlement written in advance. You have to understand that their interests are not aligned with yours. They want a moonshot or a zero. You want a business. Those are two very different things. The darkest secret is that the entire ecosystem is designed to transfer wealth from the creators to the financiers, using hope as the bait. Don't take the bait unless you know exactly how to disarm the trap. Real power isn't raising $10 million. Real power is being profitable enough that you never have to ask anyone for a dime. That is the freedom they are terrified you will find. Don't forget to like and subscribe our channel for business Relatech stories.